Hi, happy Monday. It's been a very range-bound situation recently. It's difficult to know what to get excited about when the S&P has traded in a 3% range, basically since late March all the way through April and to today. So we're just sort of holding a range. And whilst there's this debt ceiling negotiation nonsense that may cause a catalyst breakout, it's not as if people aren't aware that that's coming up again this week, and it kind of gets exhausting because it's pretty much going to come up every week until it gets sorted out. It may ultimately cause a big drama, and in fact, you remember that Janet Yellen called it by June, so we'll see. But for the moment, the market's just sort of treading water in a range, and actually for oil, it's even more extreme. We first hit $71 a barrel WTI back in mid-December, and today we're at $71 a barrel, and the range outside that, certainly by oil standards, has been very tight. The one drama this year, of course, has been natural gas, but even natural gas is bottoming here. We had a big number in the rig count on Friday, which shows you that we're now bottoming in terms of activity. And therefore, we should see a tightening of the market, certainly on the supply side, which has been the problem over the coming months. But again, it's nothing to make a gas break out in May. So it's a bit of a tough tape to get excited about. And by the way, there's not a lot on the earnings front either. We've got Home Depot's I'm more excited about because I've been spending so much time there, and it was packed again on Saturday, and I'm saying Home Depot's going to beat. But I'm an energy analyst. Nobody cares what I think about Home Depot. My trade for this week is actually long Home Depot, short Walmart, and I can be assured that nobody's basically going to listen to me on that. But I'm having my own little bit of fun in this quiet, relatively quiet tape. And you've got to remember that there's still a land war in Europe. There's still all sorts of issues in the European economy. We were showing the German industrial orders yesterday in our note. And the feature of the note was actually how China's recovery from COVID has just not been that bullish for oil, basically because it's service-led and basically because the Chinese economy is destocking. They spent 2 years stocking, not least to maintain economic activity, and now they've got to destock. So the impact on oil markets is pretty muted when you combine the biggest growth in their exports in the first quarter being oil products. That's not bullish for oil. At the same time, the US oil market is kind of treading sideways. It's huge, it keeps going, but it's just not at the margin that big a driver. And as I was highlighting, Europe never has been. You can get excited about things like India, but at the margin, they're really quite small. We're not denying there's an oil supply problem. It's just that there isn't enough demand strength at the moment to make it a problem. We are looking forward again to June, to the OPEC meeting. But at the moment, credibility is kind of shot there. You know, I went to Vienna in October. I heard them make the 2 million barrel a day announcement. I got all bulled up as we headed into winter, and they just kind of never delivered the cut. It's as simple as that. Certainly not to exports. So we're struggling with what to get excited about. Now, of course, in that kind of tape, you're like, oh, there's going to be a big deal. Oh, there's an $18 billion deal announced today. And then you look at it, and it's like One Oak for Magellan. I mean, I used to cover Magellan. I remember the largest shareholder was Paul Allen, actually. And if you look at the One Oak shareholders, they're all long onlys. So my hedge fund clients are just not going to be that thrilled about this deal compared to, let's say, the big Chevron for Oxy or, you know, Exxon for Oxy or whatever it might be. In fact, I had written that Chevron might buy Oxy for very good reasons last week, and a client very quickly told me, oh, I just met Mike Wirth, and he says there's nothing they can buy in the Permian that generates a premium for them. So it's hard to see with this lack of a big move why you would get a lot of M&A in the oil space. You may do. We do need mergers of equals, so you might want to watch out for that. But at the moment, it's all quiet on the Western Front as we head towards Memorial Day, which is, you know, never a bad thing. The markets will break out eventually. Have a great week.